Now, Property Monday continues as Margaret Lomas and her team answer all on Your Money, Your Call.
Welcome to the Monday night edition of Your Money, Your Call. And you know, if it's Monday, then we're talking all things property. I'm Lisa Montgomery and I'm filling in for Margaret Lomas, who will be back in the chair in a couple of weeks. And tonight we have another great show and it's full of property news and discussion just for you. And of course, as usual, we'll be taking your calls and answering your emails to help you make better decisions regarding your personal property investing journey. Now, to kick off tonight's program, I'm joined by regular guests, Brad Beer from BMT Tax Depreciation and Ian Rodrigues from Bishop Collins. So, with these two experts in the studio, it's a perfect night for you to ask a question, particularly if it's regarding taxation or depreciation. As always, we invite you at home to be part of the discussion, and that's a very important part. And you may want to comment about one of the issues of the day, or you may have a question for one of us on the panel. And if that's the case, then what you need to do is pick up that phone and call us right now on 1300 30 34 35, or you can email me right now on property@skynews.com.au. Now let's begin with some news. And the heads of some of the major banks have warned that it's likely borrowers will be impacted by the new bank levy announced in the federal budget. From July 1, 2017, the government will impose a quarterly 0.015% levy on an ADI's licensed entity liabilities, provided that the ADI has liabilities of at least $100 billion. It's expected that the new levy could raise up to $6.2 billion. Australia's Big Four plus Macquarie Bank will be affected. Now, several heads of the banks have hit out at the new levy, warning that any additional costs will need to be borne by borrowers. Speaking last week, NAB CEO Andrew Thorburn stated the major bank tax will impact millions of everyday Australians who are employees, customers or shareholders of banks. It's not just a tax on banks, it's a tax on every Australian who benefits from and is part of our industry. Similarly, Ian Narev, CEO of Commonwealth Bank, said that the banks will need to take some time to work through the implications of the new levy, particularly given that there's been lack of detail and absence of any consultation. Likewise, Westpac Group CEO Brian Hartzer said the new bank tax is a hit on the retirement savings of millions of Australians, as well as all bank customers. Mr Hartzer said it was disappointing that federal government had implicitly favoured large foreign banks over Australian banks operating in their home market. In addition, he said these reforms are directly counter to APRA's objective of making the banks unquestionably strong. As higher tax reductions, banks' liability generate capital that supports lending and stability in times of stress. So, interesting times, gentlemen. Welcome, Ian. Welcome, Brad. Long time since our team's been together on the panel.
A little while.
Has been. Look, we've got a lot to talk about tonight, particularly this levy and all of the other implications from the budget that was handed down last week. I want to start with this. Ian, this is an interesting one. I think the banks were blindsided when the levy was announced. I think they felt that it was their right and privilege to be consulted on this before anything was announced or even considered. What are your thoughts?
Look, I think anything that's good policy should involve some consultation. And, I mean, it is remarkable. If it's policy on the fly, this is remarkable.
Yeah.
They've come up with it. There hasn't been consultation. We saw some time ago with the mining taxes and things like that and the political campaign that got behind it. Look, at the end of the day, corporate individuals need to pay some tax. And, there is an art form to doing it. There is taxes that are better than others, that work well, that achieve their policy objective is a key thing, are effective to collect. The roadmap of what is a better tax system in this country has been around for such a long time, yet governments continue to ignore the roadmap and just make stuff up. Now, this may be good policy. We haven't really had time to assess it. And, of course, the bank's going to say it's a terrible policy, right? Of
course.
What if you would be sacked as a CEO if you said otherwise, right? But I find it very entertaining. I mean, that what the banks are saying will be passed on. I mean, it's logical. I saw Scott Morrison saying, "Oh, well, that's up to the banks." I mean, if you did Economics 101, you'd be able to work out that somehow these costs will be passed on to other parties, customers. It's normal for business. It's not picking on banks.
Yeah.
Every business has to make a fair profit. If they're not making a fair profit, then there should be more competition. So look, there's a lot of miles to go with this. I get a little bit unexcited because the last sort of several budgets we've had, a lot of announcements get made. There's a lot of smoke and dust and mirrors and argument and tweets now and everything else going on. A lot of oxygen consumed, and then nothing seems to get through. Much gets through in terms of the political fight that goes on.
Yeah.
They can't agree on some things, so they get nothing done, or very little gets through in the format they're suggesting. I think it's a wait and see.
Look, I think it is too. But Brad, we've seen a lot of activity from the banks in the last 6 months, particularly with out-of-cycle rate rises. On average, owner-occupier interest rates have risen 15 basis points, investors 30. Over 80 lenders have moved rates upward in the last 3 to 4 months. And that's all in the name of higher funding costs, which we all know is potentially not the case. But now we're looking at borrowers being hit again. I mean, do you think that this is something that the government can prevent?
Well, I was at budget and actually at the lunch the next day and listened to Scott Morrison, and he challenged them pretty hard and said you've got a choice to try to pass this on or a choice to not pass this on. And in watching some of the things that have come out of that, I don't think they've got the ability to stop it. But if you look back, some of the commentary I've watched about back to the GFC and what we did, or the government kind of did to the banks at that point, was actually guarantee deposits and help them to actually get stronger. They came out of the which is great. It's fantastic.
Absolutely. Yeah.
They came out of the GFC stronger than they probably did most businesses. And the ones that didn't come out stronger was probably the small banks. And the small banks or credit unions or all those sorts of guys came out weaker, lost their deposits, and then the bigger banks also have a lower cost of funding than they do at the moment. So they're trying to actually put some competition back in the market. And I think, well, maybe that's not such a bad thing because the government actually propped you up to make sure you were strong. And it's fantastic that you're strong. But then never giving back and giving out-of-cycle rate rises.
Yes.
APRA's putting the pressure on to make you not loan to investors, so you put the rates up.
Yeah.
What do? You make more profit by doing that. And the cost of funding for investors or otherwise, I don't know if that was different, the cost of funding in their mind for investors versus owner-occupiers, but they still increased the margins.
Yes.
Now, so there's a level of, I also believe that consultation was probably right when you're talking about these sort of dollars. And no, they wouldn't have liked it, but surely consultation may have got to some sort of decision on whether it's a fair tax before we just announce it.
Yeah.
I suppose, but sometimes there's got to be a bit of give back there somewhere.
Well, one of the, they're talking about unintended consequences with borrowers and customers being hit with this tax. I think one of the unintended consequences should be a fairer system in which sees more competition. And maybe what this will do is to help promote competition in the lender sector and also in the actual banking sector itself.
And they've hit the ones that they probably helped through the GFC and actually probably done something towards levelling the cost of funding that's different between those two.
Yeah.
So we all have competition. We run businesses. Yeah. And fair competition is okay.
Yeah, it is.
And should be.
That's right. Well, on the phone we have Daniel, and he's our first caller tonight. Daniel, how can we help you this evening?
I just want to ask the guys' opinion on the new budget measure about denying investors a deduction for plant and equipment unless they actually incur a cost to get the plant and equipment. I would have thought, what situation, apart from getting a gift of a depreciating asset, would they not incur a cost? When you buy a property, the proceeds are apportioned, across the property and the depreciating assets and the machinery, the dishwasher and stuff. Wouldn't that still be incurring the cost even on the purchase, or are they referring to the Division 43 capital works where you deduct the previous renovated kitchen. Have they got the terminology right, or am I missing something?
Okay, we were talking about this outside, and it's a perfect question. So Brad's right here to answer it, so I'll go straight to him.
Look, Daniel, I kind of agree with you. It's a little bit of a funny, and consultation would be great. It's almost some of the same questions, and now I'm on the other side of it. However, probably, it's a fairly substantial change to the rules around depreciation that really came very heavily surprised on budget night, even to myself, being there and actually talking to these politicians on a reasonably regular basis, because we have a legislation-based business. Now, I think one thing one of the main intents, from what I can understand, is they're trying to stop a tax system where people have the opportunity potentially to double dip with depreciation on assets. Now, there's less than 200 potential assets in a residential investment property, and they're attacking those ones. There's about 7,000 assets of plant and equipment across all industries that depreciate. And we have a situation where if someone buys a plant and equipment item and depreciates that item over a period of time, which is what happens, and then decides to sell that item to someone else, any of these 7,000 items, what happens is someone else buys it at a cost and they then depreciate it at the cost they purchased it at, or a market value in some way. Now, it's a bit of a loophole because sometimes the tax office actually gets claimed it twice, and it's no different with property. And they're saying it's an integrity measure to actually tidy that up, which is not necessarily a bad thing, but it probably should go across all the assets instead of just the property assets, number one. Number two, on actually purchasing, the second part of what they're trying to do, and this part, and look, in basis, there's 3 lines in the budget or a paragraph in the budget that explain this, and the government hasn't finished with the legislation. I've been talking on a regular basis because I really need to make sure we've got what it is, what it looks like, and gets it right. But the second part is about anyone who acquires an asset as the second owner of that asset doesn't actually get to claim a depreciation on that asset, which is really part of your question there. If I buy an asset, the tax office has put an effective life on that asset. I think we're going further than what they're trying to do. Carpet has a life in a residential property of 10 years. If you buy that carpet and it's 5 years old and someone's claimed half of it, there shouldn't be any reason in tax law that you shouldn't get the second 5 years. What they're doing is actually stopping that from happening, which is going beyond the intent of cleaning up this integrity measure and saying, well, what if I buy carpet in a property that's 3 months old? Sorry, you don't get to depreciate it, is what it actually looks like. What if the property's brand new? You may actually have a situation where the developer has actually bought the carpet and not you. I understand, and it's not clarified yet, that won't be the case, and being brand new, then there might be a situation where you might be able to claim that, but they haven't actually clarified that as yet. The Division 43, from everything I can see so far, is not touched. So that building allowance component stays exactly the same. So if the cost has been incurred for construction at 2.5%, then it doesn't actually change. But the plant and equipment, yes, major changes and quite an effect on investors.
Well, so we're still waiting for some clarity, is what you're saying?
Still some clarity to come, but around what it looks like at the moment, fair impact on second-hand properties.
Well, we hope that helps you, Daniel. And thanks for tuning in. And even though she's not here tonight, we'll still be giving away 2 of Margaret's books to the questions of the week, and you could win that, Daniel. The panel and I will choose one of the questions from the emails and one from the calls, and those people will receive Margaret's book, How to Achieve Property Success. And if you're ready to invest, this book will make sure you tick all the boxes in relation to the process. So all you need to do is call us on 1300 30 34 35, just like Daniel, or email us at property@skynews.com.au with a question. Then make sure you're watching to the end of the show to see if you're one of the lucky winners of Margaret's book. It's time to take a short break. Don't go away. We'll be back very soon. Welcome back, and thanks for joining me for Your Money, Your Call Property. I'm Lisa Montgomery, filling in for Margaret, and joining me tonight is Brad Beer from BMT Tax Depreciation and Ian Rodrigues from Bishop Collins. So don't waste any time, not a second. Call us now on 1300 30 34 35, or of course you can email us on property@skynews.com.au. And we've got our second caller, and it's John. John, you're calling. You're from Sydney. You're asking about Tasmania.
Yeah, Georgetown, Tasmania. What do you think? A relative's got a few properties there, and he's offered to sell me one for $220,000 in Georgetown, Tasmania.
Do you have other rental properties, do you?
Yes, I've got another one in Rockdale that's owing $250,000 on.
Okay, all right. I'll go to the panel and we'll get their opinion on Georgetown for you. Okay, John's got a question on Georgetown. We've had some interesting perspectives on Tasmania in recent shows. Some of our panellists have been pro-Tasmania and some have not. I think this one's a risk because that property's being presented to him as not necessarily one he's researching, but one that's being offered to him.
Yep.
What are your thoughts on that, Ian?
Well, I think the first point I'd make is that if you're going to buy a property from a relative, that creates some issues and you need to manage those. That can either work really well or really poorly in my experience. It's never usually in the middle. So someone will have a lingering view that they gave it to you as a bargain, even though you may have paid full market price. So doing business like that with family can be a big plus. We deal in family business. And a big negative. So in some ways, you think about all the properties in Australia that we could look at here, why that one?
Yeah.
Secondly, if it is because it's cheap or some special deal going on, be wary of the fact that stamp duty and CGT and other things apply to the parties need to be dealing at arm's length. So they will still tax it as if it was dealt with at arm's length. So, for example, I forget the number, was it
220, I think.
220, whatever the number is. Let's say that thing's really worth 400. You know, there's a whole range of tax issues that go with that. So another level of complexity. And then the choice of, if you're looking for property and you're saying Georgetown, Tasmania, well, I don't know is the answer, but I could think there would be a lot of other places I'd be looking first before I specifically went there.
Brad, this one has implications, I think, from all over the shop.
Look, I think, John, my thoughts are that the first thing you need to consider is whether you want to be a property investor and then find the property investor that fits your risk, the property as an investment that suits things like your risk profile, things like your actual personal financial situation, and things that relate to thinking about the concept of property investment and what things are going to achieve what you want to achieve over a period of time. Rather than, and I think this is anyone that looks at investing in property, rather than I've been presented with a property, which sometimes that could be a certain property presented by a certain agent or someone that you think might be a good investment. Think about the first question before you find the property. You've found the property and then thought, do I want to be a property investor? And is this the right property for me? And then after that, it's about researching areas, the drivers in areas, the things that are going to make property grow. Does Georgetown have the right ones on that? To me, I'm not an expert on Georgetown, and there's definitely conflicting advice on Tasmania. I know in Hobart that there's been a lot of growth recently because of some of the positives that exist. Georgetown, not so sure. From what I understand, the rest of Tasmania, not a massively increasing population, which is one of the drivers necessary for property growth. So that concerns me. But more of the research around the drivers for the growth, does Georgetown have them? And then, is Georgetown the area, and you are the investor that wants to buy into something like that, are my thoughts.
I guess, gentlemen, we've also got to consider why his family member wants to unload one of these properties. So, yes, that's right.
There could be other circumstances that are related to that are legitimate, and it is at a reasonable price.
I know, I'm just speculating.
But in terms of negotiation, that's a very valid point.
Yes.
Not just for his relative, but when you're looking at a property, what is the reason for sale?
Yeah, absolutely.
If it's such a cracking property, well, why is it? Now, it could be people retiring, it could be,
And I'm sure John's across that.
A motivated vendor is always the best one to be buying a property from. So if you can find one of those, and you don't want to be preying on that with someone in your family.
No, that's right. Okay, well, let's go to our first email tonight, and it's from Philip, and he asks, I've recently bought a new investment property. I have to carry out renovations to the property before I list it for rental, when that's taken us 3 months to do. I know all these renovation costs are capital in nature. My question is the interest charged on the mortgage during the period deductible, or is it also capital in nature as the house has not been let? I'm going to go straight to you on that one, Ian Rodrigues.
Well, the answer is simple and uncomplicated, and then gets complicated. So we don't... This is our tax act, right?
Yeah.
Look, the overall simple rule with interest deductibility is that it's your intention. So if your intention is to let out the property, generally speaking, deductions all follow that rule. So you intend to generate income, that's the plan. If you intend to live in it, then that's your intention and you don't get a deduction. Intentions change and you're required to adjust that accordingly. What we don't know in Philip's case is, well, not Philip's case, that's a tax case actually, but in this situation, the accountants will get that joke. So the thing we don't know is this being bought? It is for rental. There is a possibility it may be to flick it. So some people might rent it out very shortly and then get rid of it. With that comes GST issues, capital gains tax issues. Is it on income account or is it taxable as a capital gain? And the interest deductibility for when it's on income account is completely different to when you're holding a property to just buy and rent out. So the short answer is it shouldn't be a problem. The longer answer is Philip should check with his accountant to make sure that what he's actually doing is the vanilla variety of property investing here.
Right.
Yeah. So there's plenty of guidance from the ATO about when is interest deductible. You can read it all, put you to sleep. So the quick way would be to just check with your accountant about this one and make sure there isn't any problems in his particular circumstances.
Right.
So the general rule is very simple, but it gets more complicated depending on what you're trying to do.
Brad, anything you'd add to that?
No, other than that sounds like a very much a tax answer. It could be really simple, but then you add all those things in there.
I didn't make the rules,
no, exactly. But it's often the case with tax, and this is obviously no exception.
Yep.
Well, it gets complicated with the part about repairs. I think if our viewers probably understand if they've been watching the show and the other shows with the tax tips and things like that, repairs, it's terrible. You know, there are repairs that some are deductible, some are capital, some that would otherwise be deductible, like initial repairs, are capital. So it's like 4 different classes of how you class these repairs, which I think, you know, I didn't make the rules, but they just complicate things for people. So.
It's almost like, because we run across this situation on a regular basis, and not every different accountant in Australia, but a large number of them actually have a different impression of what should be claimed as repairs and maintenance sometimes.
Yep.
So if it's not going to be claimed as a repair, then it should be capitalised and depreciated, capitalised and claimed or depreciated over time. And we have to try and make a decision based on how the accountant actually interprets some of the legislation, and which can be quite grey.
And what's on the invoice. So if you get like we don't know what repair actually happened. You're seeing a receipt at the end of the year. If it says repair and renovation compared to improvement of the item, what are we meant to do? Audit it?
Well, that's right.
Repair and renovation, we better go and visit for that 100.
We can't travel now.
No, we can't. That's true. Well, so far a great night, but we have so much more lined up. It's time for a quick break, but we'll be back soon. If you do have a question for us, call us to join the queue on 1300 30 34 35 or email property@skynews.com.au. You never know, you could win the question of the week. We'll be right back. Well, if you've just tuned in, there's still plenty of time for you to call and join in on the discussion. Tonight, Brad Beer from BMT Tax Depreciation and Ian Rodrigues from Bishop Collins are here and they're ready to help you. So call us now on 1300 30 34 35 or email us on property@skynews.com.au. And we've got Dave. Dave's caller 3 tonight. And what can we help you with, Dave?
Yeah, g'day panel. Thanks for taking my call.
Pleasure.
Just wanted to ask a quick question. It's probably directed at both Ian and Brad. Do you think that the new budget measures are depreciation schedules that are existing going to be grandfathered? And the other one is I had an oven in a house that I needed to replace. So how does that work? Do I scrap that? Do I tell my accountant it needs to be scrapped because I put a new one in? And then do I have to go back to my good friends at BMT and get my tax depreciation schedule updated?
Right. Okay. I'm going to get straight to Brad on that. Brad?
Very simple. And one thing very clear from what we see from the budget first that they've made is that anyone who exchanged contracts on a property prior to budget night at 7:30, around the time it was announced, lives under exactly the same rules from the past. So even if you settled after that date, because you made a decision to buy that under a certain legislation with no grey whatever areas there, you get to depreciate based on exactly that. So anyone from the past that hasn't done it yet that needs it for the tax year, that's the same. On the oven, the other thing on that is if you then did buy something after and replaced an item of plant and equipment or just bought a new plant and equipment item, you still definitely get depreciation on that because you incurred the cost and you bought it just like you would under the old system. With the oven, there's nothing in there that says it's any different as far as scrapping is concerned. Scrapping that oven when you throw it away, if it's finished, its value, and claiming the residual value should not be an issue depending on how it's been done in the first place. And then you would put the new oven in and come on and start depreciating the new oven. With one oven, it's very simple. We actually released a portal recently called My BMT where you can actually go in and put the information online, and if you're a client, you can log in and do that. Or you can just send us, I put a new oven in and we can fix your report. It doesn't cost anything just to update an oven, and it's very, very simple online or done by us and start depreciating the new one.
Oh, anything to add there at all? Yeah.
No, I think that's, the main point is nothing's really changed about that.
Yeah.
If it's being sold as an integrity measure about that economic mismatch, there's probably some economic administrative merit in it, as long as that's all they're trying to do.
Yeah.
Yeah.
Okay, great. Well, we've got another call, and it's from Ken. Ken, you're from Melbourne, and you're asking about moving into an investment property, is that right?
Yeah, that's correct, yeah. I have the house on my normal place of residence I've just sold, and I'll be travelling around Australia and coming back in about 12 months and then moving into the investment property. And I was just wondering, is there a time limit where I don't have to pay capital gains tax?
How long have you had this investment property for?
About 10 years.
10 years. Is it your only investment property?
Yes.
And you've just sold your principal place of residence?
Yes.
Right. Okay, I'm going to go...
Never lived in it.
Oh, and have you ever lived in the investment property?
No.
Okay, you've never lived in it. Okay, straight to Ian on this one. Thank you, Ken.
So look, that's a situation that does come up, moving into a investment property. Obviously now, like I was saying earlier, your intention has changed for that property. So any debt, interest on the debt, all the costs that go with that you were claim, obviously the rental will go, and all those claims will then disappear because it becomes your private home. It would be logical for Ken to use the cash from his home to remove any debt that he may have on that property, because you no longer have deductible debt on the face of it, but you should get advice on that. But look, there's no problem. The question was about capital gains tax. So of course you've got a property that you've rented for 10 years, was bought in capital gains tax rules. When it becomes your PPOR, principal residence, obviously not subject to capital gains anymore. So you're going to have a period of time, the 10 years that you owned it that were, and then the time after that where it's your home. So there's no rule that says if I live in it for 2 years, capital gains disappears. That doesn't exist. So it's a situation where you're going to need to get some good advice around that. You're going to need to look at your cost base and valuations on this property to make sure that you minimise the capital gains tax that you're up for. Remember that you don't pay that until you sell the property. Okay, so it's not an impost that turns up when you move in, but when you eventually do sell that property, and it may not be, for a long, long time. And it may be something that even, when you're no longer here, you leave an asset to your beneficiaries and they inherit the capital gains tax status of that property, if you like. Yeah. So it's not tricky stuff, but get advice on that to make sure you understand what those obligations are, because it's really a liability that lurks in your net asset position. People don't, when you say, what do you own, what do you owe, rarely do people go, and the likely capital gains tax on my assets never usually comes into that equation, but they need to be aware of that.
Yeah. Anything to add, Brad?
Look, I guess, Ken, firstly, congratulations on 12 months around Australia. I'm sure that'll be a fantastic trip. We have a fantastic country, which is good. I'd love to see a bit more of it sometimes, not via plane. And firstly, but secondly, I think where you may be getting mixed up with the time frame probably relates to something that might happen in the future. If you decided to move out of the property for a period of time, you've got a period of time, and it's up to 6 years, where you still have that principal place of residence. You may have moved somewhere else to travel around Australia again, or who knows what else. And then you've actually got this time where the CGT is something that doesn't apply for a period of time, providing you don't have another principal place of residence. But as far as the existing situation, obviously the accountant's going to get the answer right, aren't they?
But the interesting one about that is, well, 10 years you had an investment, you move in, establish it as your principal place of residence, and then you're entitled to the 6-year rule. So you could go travelling around Australia for 6 years, rent that property back out, and it will still, as long as there's no other principal place of residence that you're claiming.
Yes.
You can have 20 principal residences, you can claim one. That would mean a year living in it and 6 years renting it out again, 7 years out of 17. You know what I mean?
Yeah.
So and that would be where the question's coming from. The rule in reverse here doesn't quite work the same. That's why we asked at the outset, did you ever live in it first? Because some of those 10 years could have been potentially under the 6-year rule. And of course, some lucky people have pre-capital gains tax properties that they've lived in, which means you can have another principal residence.
Yeah.
Because that one's exempt from capital gains anyway. Go talk to your accountant.
Absolutely. Some good suggestions for Ken. Okay, another email now, and this time it's from Chris, and he writes, I'd like your thoughts on Beresfield, Newcastle. It's 22 kilometres from Newcastle CBD, connected by the train line and the Pacific Highway. But my concern is that there's a lot of vacant land around the suburb. Not sure if there is plans to develop or how you find out about that, which may lend itself to oversupply in that area. Okay, so this is an interesting one. We all know where that is because we all have Novocastrian links here at this particular desk. So Beresfield, 22 kilometres. It's known as an industrial centre, has been. Also, it is pretty much the home of the crematorium that services the city of Newcastle as well, the main crematorium, and it's a lot of industry around there, a lot of flat land, bit of sort of wetlands, I guess, in a way too. There is a lot of land though. Ian, your thoughts on Beresfield?
Well, it is one of the few areas I do know quite a bit about. We do invest in a range of places around the country, but Beresfield's right there, and there is a lot of industrial activity around that area. The supply of residential land, if you look wider than Beresfield and surrounding suburbs and a little further up the valley, there is a huge amount of supply coming. But on the data I've seen, there is a lot of demand as well. So one of those things, if you're buying in an estate as an investment and there's many more stages to come and all of that, you've got to be realistic about your time frame here. Because there isn't as much restriction on the supply side, which is a point raised.
Yeah.
So from an investment point of view, I'd be looking into that supply-demand equation. From a living point of view, well, I mean, there's some great places up there and there's a lot of people going there. So a lot of the land is being sold, from what I can gather through my sources, to owners, and they want to live there, which is a good thing from an investment point of view because it was all investors. It's a different story as well. So that does underwrite the suburb and underwrite demand to a fair degree. So look, I like it. It's certainly, in terms of affordability, if you're talking, down on the other side of the Hawkesbury in Sydney, and affordability, it's one of those things. I think he's looking in the right places, is my view.
It's interesting because the issue that he brings up is the fact that there's, some vacant land around there. And we do talk about that potential that there could be, supply go in there and then obviously take a deviation from the capital growth that he's looking for. I guess the other thing around that too is that there could be other centres around Newcastle, Brad, that might be a better buy for him.
Yeah, and I think especially in saying that, Beresfield, I mean, the industrial thing's probably not awesome from a residential point of view because, you're at the end of the freeway, lots of trucks, but you may not be that close to it and still in the suburb. So, I mean, the benefit of actually having the freeway right there, so the access to get to Sydney is not so bad. You're right at the start of that freeway. rather than, I guess, some of the suburbs that are a bit further out that have actually done quite well, the Maitlands, etc., that have had quite good growth and things like that, is another centre, and you're kind of in between the two, but you are closer to the city of Newcastle, which is probably a positive thing. There's a lot of suburbs around, but then the vacant land does have some issue around it to me, because you're not actually landlocked, and I think the people that own that land can sort of release more. So you just got to be aware of that situation. But there's a lot of suburbs around the Hunter, and I still have a lot of belief in the Hunter and its future growth. The market's still been moving and bubbling along quite well, and I don't think there's any reason for that to suddenly stop.
No.
Other than, obviously, like a lot of the place, things are getting expensive. But then, if Sydney becomes more unaffordable, the Hunter actually becomes more attractive because it's not that far away.
No, that's right. And Beresville becomes more attractive on the train line as well.
Yeah.
Okay, well, so far a great night, but we have so much more lined up. Time for a quick break, but we'll be back soon. If you have a question for us, call us and join the queue, 1300 30 34 35, or email property@skynews.com.au. You never know, you could win the question of the week. We'll be right back. Welcome back to the property edition of Your Money, Your Call. I'm Lisa Montgomery, and joining me this evening is Brad Beer from BMT Tax Depreciation and Ian Rodrigues from Bishop Collins. We're on the home stretch, but if you do have a question, grab the phone and dial 1300 30 34 35, or email us on property@skynews.com.au. And we've got another caller this evening, and it's John. John's on the phone. He's from Sydney, and he wants to know about Daylesford in Victoria. John, how can we help?
Yes, I'm tossing a coin between Daylesford, Victoria, and a northern suburb of Victoria, northwest, South Albans, Kilo. So which way I'd be better off, in Daylesford or Sunshine, South Albans, that area? Okay,
is this obviously for investment property?
Yes.
And do you own property? You've got other investments?
Yes, in Sydney, because Sydney getting out of price now. I'm looking another state.
And what's attracting you to Daylesford?
It's a good tourist place, and I like the climate.
Okay, all right. Thanks, John. I'll go to the panel and see what they've got to say about Daylesford. Ian?
Not too much. I'm just not familiar with that area. We've done a lot of looking around Victoria for property stuff, and sticking close to the CBD has probably been our focus.
Well, this is a tourist area. It's the spa capital of Victoria. Beautiful countryside, lovely restaurants, beautiful places to stay. But it's kind of a specialist area, Brad, isn't it?
And I think almost coming back to when we say the questions you're thinking of, why you think about that area, when you answer with it's a tourist area and the climate, those two things probably concern me a bit. It doesn't mean Daylesford's not good, but tourist areas are always got some risk attached, because it's the first area. It's like every time I go to Noosa, I really want to buy that street.
Me too.
Until I see the prices, of course.
Absolutely.
And I think maybe you could have it. But the reasoning, the thoughts behind that of talking yourself out of that, if it's for tourist area, it's because it's a tourist area, or you like going to visit it, then my thoughts are that you should buy something that makes money and use that money to actually go on holidays where you want to go on holiday. Because looking at the drivers of what grows property, and they're sometimes tourism, but it's up and down, and it could be heaps and flat. And it actually depends often on other markets and how well they're doing. If people are doing really well in their property in Sydney and got lots of equity, then they're probably more likely to buy in a tourist area. But then if you had a bought into the area that's going to grow first, then you've probably got more equity to buy something in a tourist area to retire into, if that's what you actually really want to do. So I like to think about the reason I want to buy and make money first, and then think about the other area afterwards. I think you mentioned Sunshine, which is actually a lot closer to the CBD.
Yeah.
To me, I think, Daylesford, hour and a half or so, I think.
Yeah.
Fair way out. You're probably not commuting back to Melbourne too often, or wouldn't want to. There's probably closer areas. So if you're looking for proximity to, and I don't necessarily CBD is it, but areas that people the population do want to or can live in to actually have jobs around the area, as opposed to tourist jobs where you're probably looking at Dalesford. If I'm just looking at the two, the closer I think I like the better. But the drivers in that suburb are something you've still got to look at in the same way, as would be my thoughts on that.
Yeah, yeah. I mean, Ian.
The only point, it's good to hear that our callers looking outside of state.
Yes.
Again, one of the big benefits of that is you're looking. That's good. You're looking for the right place to invest. May not be there. It may be somewhere else. But the land tax benefit, he's got other properties, probably paying land tax in Sydney. If you own a property in that region, you're probably over the threshold. So that next property in Sydney, or in New South Wales rather, is going to cost you a lot more in land tax than a property in a state. Now, again, only one reason about why you'd invest in a state, but one, it's quite a significant one. When you look at the land tax values and the rates of tax, it's and it's an every year cost that comes off. So take that into the equation of when you're investing interstate. Brad was mentioning the number of people actually do that. You know, it's quite interesting to see how many people from one state invest in another. You know, and it's good that one of our callers is doing that. It's
can't claim the travel anymore.
No, just don't think you're going to be able to claim the travel allowances. But the numbers out of all the depreciation judges were done over the time, there's only about 20% of the people actually live in a different state, which we've got fairly close because we know where they come from and where they is. So most people are investing in their own state.
It's interesting how we're ending each call and each email. Well, can't claim the travel anymore. It's one of those things.
Or the depreciation.
Or the depreciation. To our next email, and it's from Andrew. And Andrew asks, could you comment on the following scenario, please? A house with 2 villa units at the back, purchased pre-1985, and units built pre-1985. If the house is demolished and replaced with 2 additional units, what are the capital gains tax implications on the new construction? Ian?
Yes, very confusing.
It is, because there's not a lot of information in there.
No. So, look, the general rule with capital gains tax, you've raised the fact that it's pre-capital gains tax, and I guess you're trying to get at the angle of, can I maintain that pre-capital gains tax, golden egg situation? Because there's not so many of these assets left anymore. Now, there are some situations where an asset is destroyed and, natural causes and things like that. There are some rollover things and to be wary of, but the general rule, talking about just demolishing the house, putting on 2 units, capital gains tax deems a very unique thing. It's called like a separate asset. So if you're over a threshold, which you would be for doing what you're doing, it will be deemed a separate asset. So the house, the units will be deemed a separate post-CGT asset to the pre-CGT land and pre-CGT other buildings. Capital gains tax is the only situation where things get treated like that, because that law, land and buildings, the law doesn't dissect it. It's all one asset. So it's a very artificial thing, but it's always been in the legislation. So you just got to remember. Now, the other tricky thing about that situation is common sense says land depreciates in value, buildings depreciate in value. So even though it's maybe deemed to be a post-CGT asset for the building, when you sell that in 10 years' time, how has that building gone up in value? And it becomes an apportionment issue for your friendly valuer to try and split at the time of sale. So I don't really know, whether the legislation actually achieves anything, but it's been in the legislation since day dot.
Right.
And makes an interesting experience for accountants to calculate it, for valuers to artificially split it. They're capable of doing that, estimating things. So I hope that explains it. The short answer is, be prepared that you may be bringing some of this asset into the CGT system.
Brad, something to add to that?
CGT is very difficult. I think in that scenario, absolutely, and making sure that an accountant who is really across it and actually looking at that particular scenario is almost the very simple answer, because there's so many what ifs that come across that.
Yeah, it's a complex question, that one.
Yeah, I know, but we usually get asked it when this has all happened and 10, 15 years forward, we get asked the question and no one's got any records anymore and all these things. And now you're not only trying to work out how does a tax act work, you're trying to find the records to
come up with a number.
So, yeah.
Excellent. Well, look, we have come to the end of tonight's show. Many thanks to my two wonderful expert guests this evening, Brad Beer from BMT Tax Depreciation and Ian Rodrigues from Bishop Collins, and they will be back on the show again very soon. Thanks also to our callers and emailers tonight. This week, our two questions of the week go to Philip, who emailed about renovations, and John, who called about Georgetown in Tasmania. So if you'd both like to email me on lisa@lisamontgomery.com.au, I'll send you your books. You can follow me on Twitter @LisaKnowsMoney, and make sure you tune in next week for another great show. I won't be in the seat, but Paul Rickard from Switzer will be, and he will have another two great property experts for you to ask questions of. So thanks for tuning in to Sky News Money. Enjoy your evening.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.